Okay, everything is set up. No más. Maybe I could. Okay. I'm back to studying cash flow statement. Cash flow statement. Thanks. I got some matcha baby. Smooth milk. Like, I don't know. I'm just not a subscriber. Okay, let's go. Study for now. Where's my timer?
Hey there, I'm James, you're watching Accounting Stuff, and in this video, we'll go over the cash flow statement for beginners. A cash flow statement is a financial statement that summarizes a business's cash inflows and outflows over a period of time. We'll get into how that works in a moment, but first, why do we need a cash flow statement? In accounting, there are two main methods for preparing your books, the cash method and the accrual method. With the cash method, you recognize your revenue when cash is received, and you record your expenses when cash is paid out. But under the accrual method, you recognize revenue as it's earned and record your expenses as they are incurred. So what does that mean? If you're cash accounting, then technically you only have one financial statement, the income statement. It summarizes your revenues and expenses over a period of time, leaving you with a profit or a loss. But with the cash method, we said that you recognize revenue when cash is received, and you record expenses when cash is paid out. That leaves you with a net cash inflow or an outflow. So the income statement prepared under the cash method is equivalent to a cash flow statement. Keep that in mind, we'll come back to it later. Plenty of small businesses do their books this way, which is fine, but the cash method isn't allowed under IFRS or GAAP.
Yeah.
Following either of these, then you must use the accrual method. So revenue must be recognized as it's earned, and expenses must be recorded as they are incurred. In accrual accounting, we still have the income statement, but this time it represents what a business has earned and incurred, not its cash inflows and outflows. So it's not equivalent to a cash flow statement. So businesses using the accrual method keep a separate cash flow statement alongside their income statement, and they also keep a balance sheet which holds their assets, their liabilities, and their equity. Not long ago, I made videos covering the income statement and the balance sheet, so you can find links to both of those down in the description. What is a cash flow statement? At the start, I said it summarizes a business's cash inflows and outflows over a period of time. But what does it look like? We begin with the opening cash amount at the start of the period and compare it against the closing cash amount at the end of the period. You can find both of these numbers in the balance sheet. The movement between the two is the net increase or decrease in cash. And once we know that, then we can get onto the real purpose of the cash flow statement, explaining how we ended up here. There are three main sections: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Operating activities are the main revenue-generating activities of the business. These are the cash flows involved in selling goods or services. Investing activities sit outside of the business's core operations. They involve the buying or selling of investments or other long-term assets. And finally, financing activities relate to funding the business, through raising or repaying cash to third-party banks or the owners of the business. This, my friends, is the basic structure of the cash flow statement. Positive numbers represent cash inflows, and negative numbers are cash outflows. Now, there are a couple of ways to make a detailed cash flow statement. We can use the direct method or the indirect method. We'll start with the direct method. Cash flow from operating activities under the direct method mirrors the income statement prepared under the cash method, which we saw earlier. At the top, we have cash receipts from customers, which mirrors revenue, and then we have the cash paid out to suppliers and employees, and then interest and taxes paid. Collectively, these mirror the business's expenses. Cash flow from investing activities includes cash outflows from buying investments or other long-term assets, and the cash inflows that come with selling them. Cash flow from Financing activities relates to the raising or repaying of cash or capital. There are two ways a business can do this, using liabilities or equity. They can borrow money from a third-party bank, which would increase their liabilities, or a business can look to its owners, its shareholders, who can make capital contributions, which increase equity. On the flip side, they also make loan repayments back to the bank and distribute dividends back to the owners. When we add up the net cash flows from operating, investing, and financing activities, we can reconcile the net increase or decrease in cash back to the movement in the balance sheet. Now, how does the indirect method work? The only section that changes is cash flow from operating activities. We use 3 steps to work it out. The indirect method always begins with a net profit or loss from the income statement. Then in step 2, we add back all the non-cash expenses that appear above it. These don't represent cash outflows and they need to be reversed out. The usual suspects are depreciation and amortization, and any gain or loss on the sale of non-current assets or long-term assets. Finally, we adjust for the movement in working capital. Working capital is the difference between current assets and current liabilities. Increases in current assets like inventory or receivables reduce cash flow, whereas increases in current liabilities like payables increase cash flow. You can find all of these numbers on the comparative balance sheet. Now you're probably thinking that the direct method sounds a lot easier. Why don't we just use that? You're right, it's easier to read, but it's actually harder for accountants to prepare, so we don't use it as much. The indirect method is much easier to work out because we can find a lot of these numbers in the income statement and the balance sheet.
Yeah, I'm actually
Example. I realize that there's a lot going on here, so I put together 2 cheat sheets covering the direct and the indirect cash flow statement. I like to think of them as one-page reference guides to help you out. If you'd like to support the channel, then you're welcome to buy them on my website.
I don't like matcha.
Up here, and
It's bad.
how do we make a cash flow statement? Yes, it's time for that example, and we'll be using the indirect method because it's easier. We'll need a couple of things to get started. First, we need an income statement. Here's one for a business called Tumble, which is a fictional dating app. We actually made this one from nothing in the income statement video, so check that out and maybe click subscribe as well. It summarizes Tumble's revenues and expenses for the year ended December 31st. And here's Tumble's balance sheet made in the balance sheet video. It shows us a snapshot of their assets, liabilities, and equity at the end of the year. But hold on, we're using the indirect method, so we actually need to see last year's balance sheet as well. So this is Tumble's comparative balance sheet. We have the current year one on the left and last year's one on the right. Nice. One more thing before we begin. Here are some key facts which happened during the year. Tumble sold some furniture for $10,000, which originally cost them $20,000 and had been depreciated by $5,000. The loss on the sale was charged to general and admin expenses. Tumble also spent $910,000 on computer equipment. They raised $100,000 in long-term debt and made no repayments. And finally, they issued $50,000 in common stock and paid out $1 million in dividends. Righto, let's begin. What are we reconciling? Cash. This is a cash flow statement after all, so let's head over to Tumble's comparative balance sheet. We can see that they held $13,895,000 in cash at the end of last year, and this number increased to $17 million at the end of this year. So we can lift these numbers and place them at the bottom of our indirect cash flow statement. Overall, that's a
Wait, cash flow is only per year? Biasanya per quarter ya?
net increase in cash of $3,105,000. But how did Tumble pull this off? Let's find out. We'll start with cash flow from operating activities. In step 1, we need to find Tumble's net profit or loss for the current year. That's easy, we can get it from the income statement. On the bottom line, we can see that Tumble earned
Net profit.
$650,000 this year
Income.
operations. We'll take Tumble's net profit and put it right at the top of cash flow from operating activities. Step 2, we need to reverse out all of the non-cash expenses. Non-cash expenses appear above the bottom line in the income statement. Some classic examples are depreciation and amortization. These represent a gradual process of writing off long-term assets. They aren't cash flows. This year, Tumble incurred $850,000 in non-cash expenses. So we'll add this back in our cash flow from operating activities. But that's not all. Tumble made a loss on the sale of long-term assets. If we jump back to our key facts page, we said that they sold some furniture for $10,000. So let's quickly do some workings. This furniture originally cost Tumble $20,000, and by the time it was sold, it had incurred $5,000 in depreciation, leaving it with a carrying value of $15,000. Tumble sold this furniture for $10,000.
Carrying value, yeah, okay.
On the sale of $5,000. This is also a non-cash expense, and it was charged to general and admin expenses in the income statement. We need to reverse it out in our cash flow statement. So we'll add back the loss
Carrying value is quite complicated.
Step 3, we need to adjust for the movement in Tumble's working capital.
Working capital.
Current assets, current assets are typically made up of inventory and receivables, and current liabilities are payables. We can find movements in all of these on Tumble's comparative balance sheet. It doesn't look like Tumble has any inventory, but they do have some receivables. Accounts receivable, other receivables, and prepaid expenses, which add up to $40,050,000 in the current year, and $8,850,000 last year. That's an increase in receivables of $5.2 million during the year. An increase in receivables reduces cash flow, so we subtract $5.2 million from cash flow from operating activities. I like to think of it this way: if receivables have gone up, then Tumble is owed more money, which isn't good for cash flow. Payables work in a similar way. Tumble has accounts payable, taxes payable, accrued expenses, and some deferred revenue. All of this adds up to $14.4 million in payables in the current year. And last year, they had $14,850,000 in payables. That's a year-on-year decrease in payables of $450,000. We subtract decreases in payables under cash flow from operating activities, because if payables go down, then more supplier accounts have been settled, so there's less cash. When we take Tumble's profit, add back their non-cash expenses, and adjust for the movement in working capital, then we can see that they had a net cash inflow of $4,855,000 from operating activities. A couple more things we need to do here to finish this off, but first I'd like to say a big thanks to all my channel supporters. You guys motivate me to keep on making more accounting tutorials. If you'd like to sign up, then
My fucking alarm.
you can click the join button. Next up is cash flow from investing activities. We're done with operating activities, so the rest of the cash flow statement is
That's the most important part, probably.
on the key facts page. We can see that Tumble spent $910,000 on computer equipment. This is a cash outflow from
Oh,
investment
that's
because they bought long-term assets. But Tumble also
Okay.
sold a long-term asset. Remember that furniture we
I was thinking like assets, so kind of like financial assets just for.
We added it back with cash flow from operating activities, but we also need to record the cash receipt on the sale of $10,000. This sale isn't part of Tumble's core business, so we record it as a cash flow from investing activities. When we total it against the purchase of computer equipment, that leaves us with a net cash flow from investing activities of $900,000. This time it's a cash outflow, so the number's negative. Cash flow from financing activities. Financing activities involve raising or repaying cash or capital used to fund a business. On the key facts page, we can see that Tumble raised $100,000 in long-term debt. This is a liability to a third-party bank, and this year they made no debt repayments. They issued $50,000 in common stock, which is a capital contribution from the shareholders who own the business, which increases equity, and they paid $1 million out in dividends back to the shareholders. That would have decreased their equity. We can pull all these numbers through into cash flow from financing activities. Tumble received $100,000 in cash from long-term debt. They raised another $50,000 in equity, and they paid out $1 million in dividends. So that's a net cash outflow from financing activities of $850,000. Almost there. When we total the cash flows from operating activities, investing activities, and financing activities, we can see that Tumble had a net increase in cash of $3,105,000 during the year. This matches the movement in cash that we saw in the balance sheet, so we've reconciled this cash flow statement using the indirect method. Oh yeah! Hope you found that helpful. Let me know in the comments what you'd like to see next time. Bye for now.
Alright. Next we're gonna be analyzing statement of cash flow. How the cash flow statement is how the cash flow is linked to the income statement and the balance sheet. Describe how the cash flow statement is linked to the income statement and the balance sheet. Well, for me it makes sense for income statement because the top line in cash flow is the net income, right?
Just look at on its sale, which we called a non-cash. Financing activities, $1,000 in long-term debt, no debt to holders who own the shareholders. Activities. Tumble received $100,000 in cash from long-term debt. They raised another $50,000 in equity, and they paid out $1 million in total the cash flows from operating activities.
Yeah, the top line is the net income, like net profit, same. Cash flow provide information beyond that available from the income statement. Yeah, so if you provide more information. Okay. Beyond the income statement, which based on accrual rather than cash. Makes sense because like it is similar. Cash flow is similar to like cash-based accounting, but the top line is profit and then the revenue and then I think sales. Expenses. Okay. Next, okay. How the cash flow statement is linked to the income statement and the balance sheet. Items on cash flow statements come from two sources. Yes, the income statement and the changes in the balance sheet. Changes in the balance sheet.
Core operations. They involve the buying or selling of investments or other long-term outflows. This is expenses. Cash flow from investing activities includes cash outflows from buying investments or other long-term assets.
Yeah, like investing the fucking long-term asset, purchase of investment. That's like similar to in the asset, so that's like from the balance sheet, right? So that's why it is from the balance sheet. Like in the asset wise, interest, tax interest, I think this is from the income statement. Cash flow, I'm pretty sure this is from the income statement as well. And maybe from cash paid cash paid to employees is in income statement or balance sheet. Primary, okay, it's cash flow statement. Accrued wage expenses, it makes sense. So yeah, I'm pretty sure like interest and tax is in the income statement. The cash flow from invested activity, this is from balance sheet. Different sales, I don't know about this one. Probably my balance sheet as well. But what is this is the indirect, doesn't matter.
$13,895,000 in cash at the end of last year, and this number increased
This is the balance
to
sheet, right?
$1 at the end of this year.
Asset.
So we can look at these
Asset.
numbers and place them at the bottom of our indirect cash flow statement. Overall, that's a net increase in cash, $3,105,000. But how did Tumble pull this off? Let's find out. We'll start with cash flow from operating activities. In step 1, we need to find Tumble's net profit or loss for the current year. That's easy, we can guess it from the income statement.
From income statement,
We can
yep.
see that Tumble earned $9,650,000 this year from their core operations. We'll take Tumble's net profit and put it right at the top of cash flow from operating activities. Step 2, we need to reverse out all of the non-cash expenses.
Non-cash
Above
expenses.
the bottom line in the income statement. Some classic examples are depreciation and amortization. These represent expenses. Non-cash expenses appear above the bottom line in the income statement.
What is non-cash expenses?
Some classic examples are depreciation and amortization. These represent the gradual process of writing off long-term assets. They aren't cash flows. This year, Tumble incurred $850,000 in non-cash expenses. So we'll add this back in our cash flow from operating activities. But that's not all. Tumble made a loss on the sale of long-term assets. If we jump back to our key facts page, we said that they sold some furniture for $10,000. So let's quickly do some workings. This furniture originally cost Tumble $20,000, and by the time it was sold, it had incurred $5,000 in depreciation, leaving it with a carrying value of $15,000. Tumble sold this furniture for $10,000, which left them with a loss on the sale of $5,000. This is also a non-cash expense, and it was charged to general and admin expenses in the income statement. We need to reverse it out in our cash flow statement, so we'll add back the loss on the sale of furniture of $5,000. Step 3, we need to adjust for the movement in Tumble's working capital. Working capital is the difference between current assets and current liabilities. Ignoring cash, current assets are typically made up of inventory and receivables, and current liabilities are payables. We can find the movement in all of these on Tumble's comparative balance sheet. It doesn't look like Tumble has any inventory, but they do have some receivables. Accounts receivable, other receivables, and prepaid expenses.
Oh yeah, like this is comparative, right?
Current year.
We compare
and increase in receivables of $5.2 million during the year. An increase in receivables reduces cash flow, so we subtract $5.2 million from cash flow from operating activities.
Yeah, I got it. So yeah, so it is like comparative from last year, right? Okay. Cash flow operation inflow and outflow of cash resulting from transactions that affect net income. Also related to the firm current asset and current liabilities. Yeah. This is from operating. I guess yeah, inventory is also from the balance sheet, like increase receivable. Also to the firm current asset and current liability. So in cash flow operation, core activities here. We use income statement and balance sheet to calculate some of the value. Working capital. Oh yeah. Adjust for movement in working capital, which is asset minus liability, and that all that is from the balance sheet. The non-cash expenses like compensation, it's also like depreciation.
Of cash flow from we said that they sold some fools, which left them payment. We adjust for the movement in Tumble's working capital payment, so we'll add back the loss on the sale of furniture of $5,000.
Depreciation or amortization. Okay. I don't get why it's like
of long-term assets. They aren't cash flows. This year, examples are depreciation and amortization. These represent the gradual process of writing off long-term assets. They aren't cash flows. This year, Tumble incurred $850,000 in non-cash expenses. So we'll add this back in our cash flow from operating activities. But that's not all. Loss on the sale of long-term assets. If we jump back to our key facts page, we said that they sold some furniture for $10,000. So let's quickly do some workings. This furniture originally cost Tumble $20,000.
Okay, wait. Cash flow and cash flow in investment, inflow and outflow of cash resulting from acquisition of or disposable long-term asset and certain investment. Cash flow financing, firm capital structure, non-current liability and equity. Our cash flow statement is linked to the income statement and the balance sheet. An analyst can use the statement cash flow to assess a firm's liquidity, solvency, and financial flexibility, including whether regular operations generate enough cash to sustain the business, whether the firm generates enough cash to pay off existing debt as they mature, whether the firm is likely to need additional financing, whether the firm can meet unexpected obligation, whether the firm can take advantage of new business opportunities as they arise. Okay. The cash flow statement reconcile the beginning and ending balance of cash over the accounting period. The change is a result of firm operating, investing, and financing activities as follows. Operating cash flow, investing cash flow, financing cash flow equals change in balance. What the fuck am I doing? Okay. The slide showed that changing cash balances is some of the distinct business activities. Investing cash flow, financing cash flow, beginning cash balance, operating cash flow, operating cash flow, investing cash flow, and financing cash flow. Reconcile the balance sheet, beginning cash balance, change in cash balance, ending cash balance. Change in cash balance. Salah. A cash flow statement is the link to the income statement and the balance sheet. Earnings are considered to be high quality when operating cash flow, which can also be called cash flow from operation, are close to or are higher than reported earnings. If earnings are consistently higher than CFO, cash flow from operation, their quality is lower. Okay. Earnings are considered to be high quality when operating cash flow, which can also be called cash flow from operation, are close to or higher than reported earnings. Makes sense? That means like operating wise is like the company doesn't use that much cash money. I just money. The company doesn't use that much money to, for example, employees to bayarin employee-nya lah, kan? If earnings are consistently higher than CFO, their quality is lower because the accrual-based earnings are not backed by cash creation from operating. Because the accrual-based earnings are not backed by cash creation from operating activities. I'm in the sentence. Accrual-based earnings are not backed by cash operating earnings. Ya, earningnya mereka nggak ngaruh karena hash base. Like it, yeah, basically that's what I'm thinking. Right? Some kind of, yeah, like maybe earningnya um, backed by cash. When earnings are backed by cash, it means everyone profit are reported. There is roughly one or more of actual cash flow of operation entering the company. High quality earning. Oh, really? Bigger than like operating cash flow, which can also be called CFO, are close or higher than the I guess you can just like divide it, right? Yeah, cash to income, yeah, cash flow to revenue. Yeah. That's what I was thinking. Like I feel like cash flow, rubber dividend, weighted average number of shares. Okay, makes sense. Um, transaction for which the timing, that's less. Transaction for which the timing or of revenue or expense recognition differs from the receipt or payment of cash or whether it's changing balance sheet. Transaction from which the timing of revenue or expenses recognition differs from the receipt or payment of cash or whether it's changing. Okay. My brain is fucked right now. Already? Okay. Let's take a break. Fuck, I forgot to set the timer. Okay. Wait, wait. Banyak sama. Okay. Oh my god, Rene. Yeah. Right, okay. I feel like I've seen. Yeah. Chill City Pub. What kind of AI slop is this shit, bro? Ini the cover. Atin, sure. "2015 nostalgia. It's 9 years ago. It's not nostalgia. It was like sometime that makes sense. Fuck. I'm old as fuck. 9 tahun anjing. Go. Paragraph explain the bridge between income statement. Okay. Transaction for which the timing of revenue or earnings are considered to be high quality. Transaction for which the timing of revenue or expenses recognition differs from receipt or payment of cash are reflected in the change in the balance sheet account. For example, when the revenue exceed cash collection, the firm has sold items on credit and accounts receivable on asset increase. The opposite occurs if customer repays more on their outstanding account than the firm extend in new credit. Cash collection exceed revenue and accounts receivable decreases. Similarly, when purchases from supplier exceed cash payment, account respect. Okay. What does it say? Because accrual accounting, companies often record transaction today, even the cash move month later. The balance sheet acts as a storage room for these timing differences. That's what I was thinking, right? Because account payable, account receivable, like that kind of stuff. And the revenue side, accounting receivable is an asset that tracks money customer owe you for sale already made. When sales is bigger than cash collection, you're selling item on credit faster than you are collecting the money. This creates growth in your account receivable balances. When cash collection is bigger than sale, this usually happens when you stop giving new credit and start collecting old IOUs from previous month. This causes account receivable to go down. Okay, the expense line, accounts payable. Account payable is a liability that tracks money you owe to your supplier for goods already received. When purchase, summary. Beginning plus sales at cash collected. Well, are there really cash collected in the non-cash? Oh yeah, increase in like receivable, payable, inventory. Yeah. Okay. Shit. Okay, nice. Okay, that is okay. It is helpful to understand how transactions affect each balance sheet account. For example, account receivable are increased by sales or credit. Account receivable, on credit, and decreased by cash collection. Revenue recognition started effect when sales is recorded in the income statement, but not the timing of cash flow from the customer. If a firm receives cash from customer in advance of sales being recorded in the income statement, cash received will appear in the cash flow statement at the same payment, not when the sales is recorded. Okay. Revenue recognition started effect when sale is recorded in the income statement, but not the timing of cash flow from customer. If a firm receives cash from a customer in advance of the sale be recorded in the income statement, the cash received will appear in the cash flow statement at the same time of payment, not when sale is recorded. Example of connection: cash flow, balance sheet, and income statement. Sorry, alarm. Pekerjaan, cash flow, balance sheet, income statements. Job has been finished. Cash has been paid. Cash has not been paid. Kalau job has been finished, cash in the balance sheet, it doesn't matter. In the income statement, it still sales. Cash flow, cash has been paid. Cash has not been paid. Account receivable, sales. Job has not been delivered. Cash has been paid. Unearned revenue. Cash has not been paid. Example of account receivable. Beginning account receivable plus sales, account receivable, cash collection. Beginning account receivable 10,000, sales 50,000, ending cash collection. Steps in the preparation of a direct and indirect cash flow statement. Describe the steps in preparation of direct and cash flow. The difference in two methods relates to the presentation of cash flow from operating activities. CFI activities is exactly the same under both methods. The direct method presents a firm statement of cash flow, show only cash payment and cash receipt over the period. The analysis can see the actual amount that went to each use cash that was received from each source of cash. Direct method, each line item of accrual based income statement is converted into cash receipt or cash payment.
At the top of cash flows with a net profit or loss and balance sheets. You can find links to both of those down in the description. What is a cash flow statement? At the start, I said it summarizes a business's cash inflows and outflows. Cash flow from operating activities under the direct method mirrors the income statement prepared under the cash method, which we saw earlier. At the top, we have cash receipts from customers, which mirrors revenue, and then we have the cash paid out to suppliers and employees, and then interest and taxes paid. Collectively, these mirror the business's expenses.
That looks so easy.
Buying investments or other long-term assets.
I feel like it's hard
and selling them. Cash flow from financing activities relates to the raising or repaying of cash or capital. There are two ways a business can do this: using liabilities or equity. They can borrow money from a third-party bank, which would increase their liabilities, or a business can look to its owners, its shareholders, who can make capital contributions, which increase equity. On the flip side, they also make loan repayments back to the bank and distribute dividends back to the owners. When we add up the net cash flows from operating, investing, and financing activities, we can reconcile the net increase or decrease in cash back to the movement in the balance sheet. Now, how does the indirect method work? The only section that changes is cash flow from operating activities. We use 3 steps to work it out. The indirect method always begins with a net profit or loss from the income statement. Then in step 2, we add back all the non-cash expenses that appear above it. These don't represent cash outflows and they need to be reversed out. The usual suspects are depreciation and amortization, and any gain of it. These don't represent cash outflows and they need to be reversed out. The usual suspects are depreciation and amortization, and any gain or loss on the sale of non-current assets or long-term assets. Finally, we adjust for the movement in working capital. Working capital is the difference between current assets and current liabilities. Increases in current assets like inventory or receivables reduce cash flow, whereas increases in current liabilities like payables increase cash flow. You can find all of these numbers on the comparative balance sheet. Now you're probably thinking that the direct method sounds a lot easier. Why don't we just use that? You're right, it is easier to read, but it's actually harder for accountants to prepare, so we don't use it as much. The indirect method is much easier to work out because we can find a lot of these numbers in the income statement and the balance sheet, as you'll see in this next example. I realized that there's a lot going on here, so I put together 2 cheat sheets covering the direct and the indirect cash flow statement.
Okay.
I like to think of them
Each line of item of accrual income statement converted to cash receipt or cash payment. Cash paid to receipt from customer, cash paid to the supplier, to employee, to receipt paid.
prepare, so we don't use it as much.
Fuck, now I really want to fucking I really fucking do that. Second.
The indirect method is much easier. Why don't we just use that?
Step to prepare a direct method, start at the top of the income statement with revenue. Examine the balance sheet for asset or liability, typically current, related to income statement item. Compute the change in the balance sheet, asset or liability. Adjust the income statement for the change in the balance sheet not. Subtract an increase in an asset. Subtract an increase in asset or add a decrease in an asset, source of cash. To adjusting the income statement, yeah, similar cash from receipt. Cash receipt from customer, cash paid to supplier, cash paid to employee. It's more complicated. Cash paid to accrued expense, cash for interest, cash from interest paid, tax paid, similar operating cash flow. Cash paid from operating expense. This is cash paid to employees. Okay. Cash from collecting from customer. Well, I thought this is just a so much better method than earning. then I don't know, it's me. uh, Average cash flow operation is a much better number to value than while Warren Buffett would congratulate you on moving past net income, he would argue that cash flow is still incomplete number. Oh, interesting. It's the Buffett perspective on why goes one step further. The owner earning philosophy. Buffett famously coined the term owner's earning in his 1986 letter to Berkshire Hathaway. He argued CFO is misleading because it ignores silent killer of wealth, capital expenditure. The logic: if a company generates 10 million in cash flow operation, it has to spend 9 million of every year just to replace old machines to stay competitive. The owner only actually sees 1 million. The version trap: if you value the company based on 10 million CFO, you will be massively overvaluing them for a business that aids is on cash just to survive. It's just that. Buffett owner's earning is essentially the same as free cash flow to the firm FCFF, mentioned in slide 28. Sometimes later in the future. Average annual capex. Net income plus depreciation as amortization. Free cash flow as the available for discretionary. Why he prefers this over net income? Buffett famously worry of provision for taxes and depreciation on the income statement because they are subject to accounting estimate. Yep. Revenue can be fake, as noted in slide 6. Revenue recognition standard can record sales before any cash is received. CFO is harder to fake. It represents the actual cash receipt and payment. During the period, the most checked Buffett look for companies where CFO is much higher than capex. If a company can grow without having constantly reinvest into cash and to equip new equipment as to article. Okay. What is the formula of free cash flow? Free cash flow to the firm. Pak, give me a second. And does account for dividend? I feel like free cash flow hasn't. I feel like it still haven't. Free cash flow represent cash available to all investors in the company, including both stakeholder and bondholder. There are two primary ways to calculate using the data. Misal, this one does the non-cash accounting and interest payment. The net income, okay. Non-cash charges like depreciation, interest expense, tax rate. So okay, free cash flow inventory, free cash flow working capital investment. CFO plus interest expenses, tax adjusted because belong to the bondholders too, so we ignore the cost. And free cash flow inventory. This free cash flow, no, it does not subtract dividend. In fact, it is the pool of money that is used to pay those dividends. They anticipated new clear cash usage for anyone that should look at this out. The hierarchy of cash flow for business, free cash flow after the business pays its own maintenance, capex, FCFE, cash for just owners and lenders are paid, dividends the actual cash. Okay. What is the owner is a shareholder who does not add back interest in the monetary valuation itself by the bank, not something the owner can spend. The whole firm measure total cash produced by the business before any investors are paid, measure what the owner can actually take home at the end of the year. Add back interest, treats interest as a distribution of cash, not expenses. Treat interest as a cost of staying business that is available to the owner. That's what I was thinking, right? It's like it should be. Oh my god. Total subtracts all fixed capital investment made during the period. Only subtracts the cash needed to maintain current position, not necessary growth spending. Used to value the entire enterprise. Used value to common equity. Nuanced capital expenditure. This is where Buffett logic is most distinct from standard shape calculation. Standard free cash flow usually subtract all fixed capital investment is shown on the cash flow statement. The argue that if a company spends money to double its factory size, growth capex that shouldn't count as its earning because it's valued investment out of the future. You only want to subtract maintenance capex, the money required to keep the business running exactly as it's today. Which one is the fault? Is one is closer to Buffett? If you have to pick CFA metric that mostly closely matches to Buffett, other than it would be free cash flow to equity. Free cash flow from equity, cash flow operation. The big takeaway: free cash flow tells you how much the entire machine is worth. Owner earning again. Since you are looking this valuation, you must be. This is step in preparation. Prepare a cash flow statement using the direct method for a company with the following income statement on sheet. This is the income statement that is sales, expenses, cost of goods sold, wages, depreciation, interest, total expenses, income from counting operation, gain from sales line, pre-tax income, provision from tax, and net income, common dividend and declared. This is the income statement. Step in preparation of direct and indirect cash flow statement. This is the balance sheet. Yeah, we look at the last year as well, 2026. Yeah. This is the income statement, 2027 and 2026. Step in preparation of direct and indirect. Okay, I'm gonna write it down. So this one is cash from operation, cash from fuck. My ballpoint is fuck. So cash collection. Sales or like revenue minus increase in air. Account receivable. Okay, let's look at sales. The sales is 100,000. So apa namanya? Which is this is $100,000. I'm guessing. Minus yang baru berapa? What is the current account receivable? Is 10,000 plus 9,000. I'm guessing. Yeah, 99,000. That makes sense. That's cash collection. Next is cash paid to supplier, and that is apa namanya, minus cost of goods sold plus decrease in inventory. Account payable. Okay, let's say cost of goods sold is 40,000. decrease in inventory. Let's see this. Good. Inventory. Oh, it does decrease for 2.000. Increase in uh account payable. Account payable. It does increase for 4,000. Okay. And then cash wages, similar to cash to employee. So minus wages, decrease in wage payable. Wages, where is wages? It's somewhere, yeah, it's an income statement. Decrease in wages payable, it should be on the balance sheet. Wages payable, it's it does decrease for 350, which is around, okay. There's cash interest and cash taxes. Cash interest, which is basically, what is it again? It is interest expenses. Okay, interest expenses. What's interest expenses? Increase in interest payable. Interest increase, interest expenditure. It's interest, right? Yeah, it is interest. Okay, interest expenses, dollar plus increase in interest payable. It's definitely on balance sheet, right? Interest payable, it does increase for $500. So it is $0. And last one is cash taxes. Okay, cash taxes because tax expenses. Increase in tax payable. Increase in deferred tax. The fuck is that? Wait, in deferred. And tax expense should be on the income statement. So wait, no. Tax income from continuing operation, gain from provision from taxes. Yeah, provision from taxes. That's what I think. Some should be on the income statement. And then increase in tax payable, it should be on the balance sheet. Tax payable is 5,000. And then increase in deferred tax liability. Deferred tax liability, it does increase for 5,000. So another 5,000. Give me a second. Why is it Oh, I'm retarded, yeah. And then we just subtract all of that. And then, okay. Okay. Doesn't look like it doesn't look that complicated. The fuck? Yeah, solely voice prohibited. Not average. I wanna sleep. It is only been like 1 hour. After 2 hours. Okay, let's go. Sabar gue. I don't care about, to be honest, I'm too lazy to care about the cash flow investment and cash flow from financing. Sorry, financing cash flow investing, cash from investing. Sales. Udah. Step in the preparation of direct and indirect cash flow statement. Step to calculate operating cash flow using indirect method, so we can net income and then subtract gain or added loss that resulted from financing or investing cash flow. Add back all non-cash charges to income and subtract all non-cash component of revenue. Add or subtract changes in the operating budget. So cash flow operation equals net income minus what the fuck is NCC? Okay, wait, I need to look at it. Non-cash charges. Okay. Non-cash charges. And then the last one is WTA inventory. It's long essence. WTA inventory. Transfer. Working capital investment. Ending working capital, beginning working capital. Okay, working capital investment. Minus or minus? Okay. Working capital investment. So we have net income plus non-cash changes like depreciation and amortization, right? And then subtract balance sheet operation. So asset minus liability. Yeah. Step in the preparation of direct and indirect cash flow statement. So we calculate the cash flow operation using direct indirect method. So net income 375, subtract gain from sales of land, add back non-cashes of depreciation of 7,000, subtract and increase receivable and inventory. Net income, gain from sales, depreciation. Okay. It should be the same, right? I'm pretty sure. Yeah, 4,500. Increase in deferred tax, increase in tax payable. All of this increase is from the balance sheet, right? This is from the income statement. If I look at this, there should be some income from sales of land, 10,000. Depreciation, step in the preparation of the direct and indirect cash flow statement. Both IFRS and USGAAP encourage the use of statement cash flow in the direct format. Statement cash flow under the direct method must include footnote disclosure of the indirect method. Okay. Step in the preparation of direct and indirect cash flow.
しやハートを立てて低い空へ飛び立つ木漏れ日がトンパンをゆっくりと西へスライドしていく
Definitely.
Soft hum of the neighbors heater through the wall 隣室から漏れるかすかなけど Hope a silent proof of life in the concrete Sinking with the breath of the midnight city 深夜の金管を深く吸い込み The pulse is slow, the connection is real 不透明な孤独を安らぎに変えて Floating in the grid of the sleeping world 誰もいない通りで等間経過にまたがく前ちょっと遠いビルの浴場でまたが赤い灯火ビルの Signals of a steady existence 動かないままで受け取る生存の合図同じ闇を共有しているという無言ド連帯 Blue light reflecting on the kitchen tiles 換気扇が吸い上げる一日の凝り顔 It's not a void, it's a collective rest 不要な虚勢を冷えた床に委ねただ世界が眠っていることの慈しみを知る Sinking with the breath of the midnight city 深夜の銀行を深く吸い込み The pulse is low, the connection is real 不透明な孤独を安らぎに変えて Floating in the grid of the sleeping world Fan vibration of the city's undercurrent 地下を流れる巨大な血液の鼓動 Is there a harmony in the static air ただ目覚めを待つという静かな準備が自分という存在を優しく Who makes certain The time is frozen, the mind is open 明日という指導を一度だけ猶予して
Oh, common sense. Okay. Yeah.
Deep in the silence of the shared night 最後の日だけの窓明かりが静かにまどろみの中へ消える暗闇の密度が増し一人の呼吸が街の一部になる
This common size, which is percentage and net income. Oh, this is crazy.
Trace the warmth on the polished slats 誰かが去った後のわずかな温度の余韻 A collective seat in the station hall 硬い木材が受け止めていた重みの記憶次に座る誰かへと引き継がれる急
net income, non-cash charges, interest, fixed capital investment, working capital investment, capital cash flow from operation. Calculate and interpret free cash flow to the firm. Free cash flow. Okay. And free cash flow for equity to equity. Yeah. Equal to the CFO minus free cash flow inventory. Investment, fixed capital investment, different stuff. FCI gitu kalau ya. Net turun. Fixed capital investment, net capital expenditure, net capex, and then net borrowing, debt issue, debt pay. Oh my god, there's so many proposals. Cash flow to revenue, cash flow to average total asset, average total equity, operating income, which is revenue minus cost of goods sold and ratio of net income. Cash flow per sale, cash flow per dividend, weighted average earning per share, right? Debt coverage ratio, coverage ratio, interest ratio, performance ratio, interest coverage, dividend payment, debt payment, cash flow to oh yeah, problem solving. Okay. Okay, so we have this problem which is trying to calculate cash flow operation, which is equals net income plus non-cash changes minus working capital inventory. Non-cash is very easy. So we just add this, right? No, this one's a high. Decrease in account receivable and depreciation. How do I start? What if I just so we have cash collection, which is equals sales, which is net income, 20k minus increase in account receivable, which is decreased, so we just add that. What about cost of goods sold? decrease in inventory, so increase in account payable, increase in account payable. What's cost of goods sold? Like, where's the income then? Or you don't need to? Oh yeah, working capital is asset minus liability, right? Yeah, asset minus liabilities. I'm pretty sure NCC is depreciation, so that's like 25. I don't know what gain is. Profit. I'm guessing profit. Profit from sell fixed asset, increase in deferred tax liability. So profit from sales fixed asset. Losses. Okay. So decrease in account receivable, because it decreased account receivable, we lower the asset, right? Because account receivable is from the asset. Increase in inventory, that's plus an asset. Increase in account payable, decrease in wages payable. But liabilities, so increase in inventory, no increase in account payable, that means we increase by 7,000. And decrease in wages payable, we minus 5,000. Give me a second. So profit from sales and fixed asset has already been added. okay, net income, sorry, added decrease in account receivable, added depreciation is gain, I'm pretty sure. No, it's NCC, sorry. NCC. This a net income. And then okay, wait. Okay. Decrease in account receivable is asset lu berkurang, right? And then plus 10.000 wait, depreciation 35, increase in inventory, that mean the asset get higher, increase in account payable, that mean increase in liability, decrease in wage payable, because payable I'm guessing it's going to be on auto obligation 20 minus 5,000, increase in deferred tax liability, deferred tax liability. It's cash taxes. I don't know where that is though. The tax liability, profit from the sales of fixed assets, so I'm guessing that are gonna be gains. Right. Okay. Add back non-cash, so we add depreciation for 25. That's correct. Adjust for asset changes. Because we decreased 20,000, yes, true, and increase inventory. Which is 7,000 increase in inventory. It's wrong. Increase in inventory is 10,000. So adjusting liabilities, increase in accounts payable. Okay, accounts payable. Yeah. Same. Decrease in wage payable. Okay, wage payable it is okay, it's actually less. Decrease wage payable. Oh no. Wage payable if 5K. Okay. Increase in deferred tax liability. Deferred tax. Okay, so it does. Okay, so increase in deferred tax liability, and then fixed asset. Increase profit from sales of fixed asset. That's 2,000. Okay. Okay. And this is equals to 14. Okay. It's done. I've read all the material. Bullshit.
Faded pocket holding the shape of
Hello, I'm James. You're watching Counting Stuff.
Like reflection on my window. Hopefully you won't see me. I put the face that has been worn out just today. 115, that clock talks to me. I can't seem to make it stop. All the noises echoed in my head. Everywhere I go,
Hello, I'm James.
memories within me still remain so strong. But I can't go on repeating melodies of the past to get by. Tell me what's this emptiness that keep holding me from moving on. Everywhere I go, all the voice around me still remain so loud, and I can't go on repeating melodies of praise. Surely, is it for me? Is it for you? Tell me. Oh, I have ever wanted was to see so free. Then how do you Everywhere I go, memories within me still remain so strong. But I can't go on repeating melodies of the past to get by. Tell me what's this emptiness that keep holding me from moving on.
Everywhere I go.
All the voice around me still remains so loud, and I can't go on repeating melodies of praise. Surely, is it for me? Is it for you? Tell me. Is it for me? Is it for
Okay. Great song, boy. Love the song. Okay, one more is a song. I love that type of music. Bro, come on. I have a look at. Okay. An analyst has that observed that the company net income has been steadily growing at 12% per year, while its operating cash flow has been stagnant and declining over the same period. Based on this relationship, the analyst should most likely conclude that the company is aggressively investing in a fixed asset. The quality of a company earning is low. The company is paying off its debt too quickly. Okay, for the year 2025, retail reported total sales revenue of 150k during the year. The account receivable balance increased from beginning 25 to the ending 35, and the direct method, what is the amount of cash collected from customer. Let's see. Okay. A manufacturing firm reports cost of goods sold of 80k during the year, and its inventory balance decreased by 5k, and its account payable balance increased at 8k. And the direct method was the cash paid to supplier. So cost of goods is 80k, and its inventory balance decreased by 10k. Inventory balance, okay, and account payable. It's A, I'm pretty sure. Under US GAAP, how much a company classify interest paid dividend pay on its own statement? How much a company classify interest paid and dividends paid on its statement of cash flow? I don't think it matters. I thought, wait, what? Dividend paid. Yes, USGAP is cash flow from financing, but interest is cash flow operation. Fuck. Okay, based on the following data, calculate the cash flow operation using the indirect methods. Okay. Based on the following data, calculate the cash flow using the indirect. So net income is 50k. Depreciation, expenses, and amortization, that, so we add that 12k. Gain on sales machinery, we remove the gain. Increase in account receivable. Account receivable is asset, and I mean asset increase. So we minus 6k, right? Account payable increase, not increase, so plus 3. The 5k, which is B. Yep, okay. A technology startup is currently at the start of the growth segment in its business life cycle. Due to style, method, cash flow, which of the following is more? So startup, financing is still quite high. CFO could be, it's like starting to go up, starting to be from negative to positive. And financing is starting to go down, and investment is still negative, right? So positive net income. Okay, so cash flow is growth segment. Which of the following combination of net income is most likely? So negative operating cash flow, positive net income. Which are most likely? Negative net income, positive net income. Definitely not positive. I feel like it's like a hardly. Yeah, so C. Which of the following cash flow metrics best represent cash available to all provided capital, both debt and equity holder? Is cash flow? No, it's free cash flow to firm. So let's see. A company report cash flow operation of 120 during the year. The company is paid 10k in interest, expenses, and purchase. 5 worth of new equipment. Free cash flow inventory. If the corporate tax is 1.3, so it's 3%. What is the free cash flow to firm? Free cash flow is equals net. Cash flow operation, which is 120, plus I think the company interest and expenses. So during the year, a company paid interest and expense, so 10k as interest, 1 minus 0.3 minus the interest, a new equipment, and purchase new equipment. So 45k, 120 plus $7 minus 45, 55 plus 20, 82 B. Okay. An analyst is calculating free cash flow to equity for a firm. The firm reported CFO. Okay, this is free cash flow equity. CFO 200 and fixed capital investment 60 during the firm used 30 new bonds and repaid 10 existing long-term bank loan. What is the free cash flow investment?
The book is closed, the truth is exposed. 明日という見どこを一度だけ保留して
I like fixed capital investment is always negative. That makes sense. During the term, issued 3,000 new bonds and repaid 10,000 existing. So because issued, so we plus 2,000, 20,000. So this is 40. So 160. It's B, yeah. When preparing a common size cash flow statement to identify trends and forecast future cash flow, each line item is most commonly expressed as percentage of common size cash flow statement to identify trend and forecast its revenue. Yep, okay. I got most of it correct, so like 7 or 8, so pretty easy. Okay, that's it for this stream. It's been 2 hours, not bad lah. Good, no, it's not been 2 hours. But I did consume it better than I did. Lebih cepat sih belajarnya, materinya. Mungkin karena gue tertarik, karena cash flow, karena sebagai value investing, sama ya videonya bagus banget yang dikasih sama. Okay. That's it for